Hi, everybody, and welcome back to yet another cracking installment of the Matt Brown Show. This is the Private Placement Perspective series, where I'm connecting you to venture capital firms and guys you know a hell of a lot more than me about investing in alternative investments. And with us on the line is none other than Nick Cooney. He is the managing partner at Lever VC. Did I say that correct?
You did indeed, Matt, and thanks for having me on. Look forward to chatting today.
Yeah, exactly. American pronunciations are still not quite up in my wheelhouse, but I'm getting there slowly.
Won't take either. Lever or lever, all good.
Yeah, all good, all good. Yeah, exactly. Cool. Well, look, thank you so much for being here. You've got a really interesting venture capital firm, so I'm super stoked to have you here, Nick. So let's start with some fundamentals. Why don't you give our viewers and audience around the world a little bit of context about what you're doing at Lever VC, and talk to us a little bit about how you got started in the world of venture capital and investing.
Yeah, sure thing. So we are a pretty specialized early stage VC fund. Our focus is food tech and ag tech, and more specifically, our focus is the future of protein. So we're investing in early stage companies in the alternative protein sector, as well as some related sectors that tie into this future protein. From a high level, there's a lot of people in the world, and there's more to come, and those people are eating more and more protein. And so this is a very large market that is growing and will keep growing for decades to come. And at the same time, there are both consumer tailwinds, resource tailwinds, and other things, climate change concerns and other things that are driving the growth of the alternative protein sector, as well as other shifts in this industry. So we invest in early stage companies around the world, North America, Europe, Asia, LATAM, elsewhere, that we view as crafting the future protein. We're a global VC fund. Our team's largely split between the US, where I'm based, and some other colleagues are based in Hong Kong. We've been doing this, our Fund 1, since 2019, so we're about 4 years in. And prior to that, I was investing into the same category from a family office investment vehicle, also based out of the US, as was our other founding partner, Lawrence. So how I got into it, to your second question there, I've been working in this category for about 16, 17 years, this alternative protein space. Further back, there was in a few different areas, including on the NGO side, so working with large food corporates to help them add more of these products to their portfolio, working to educate consumers both here in the US and abroad about the value of these products, and then began investing in the space in 2015. So investing in it for about 8 years at this point.
It's super exciting. I went to the University of Denver. I met the faculty head of entrepreneurship at DU, Denver University. And they had literally just started their sort of entrepreneurship program. It was the first year, and it culminated in this. It was like, I would imagine, it's kind of like a pitch. Like, so you have these 5 startups, typically teams, and they, as a consequence of going through their program, they then had this pitch at the end. And I went there to just experience what was going on. And one of them was really, really fascinating. And it's actually someone I could potentially connect you to, because what she was, fascinating youngster, I must say. I mean, I can say the word youngster now because I feel like I'm getting on a bit. So her startup, really fascinating. So she was saying that there's a shortage of protein in the world. Like the requirement for and I'm probably getting a lot of these facts wrong, but the idea was there's an issue with the current protein supply and the impact of like cows on the environment and sustainability and all this kind of stuff. And so what she had done was she had developed an alternative source of protein based off bugs, so like insects. So she'd created this range of products that were, I think it was like muesli, and they had alternative sources of protein within these products, and they came from bugs, all manufactured locally here. And it was very funny. So my sister was here at the time, and so I took one of the packets because I tasted. I was like, this is actually, like, I could eat this. Like, if I really thought that this was an issue, like, I could switch to this type of breakfast, right? And I said, I gave it to my sister, and I said, here, try this. I met this startup, she's got this cool product, but I didn't say what was in it. And so she put it in her mouth. She goes, "Well, this tastes really, really good." And I'm like, "Yeah, well, do you want to know what's in it?" She goes, "Well, what's in it?" And I'm like, "Insects." And she's like, "Oh," like she couldn't handle it. She literally anyway, it was a funny story, but it's interesting because it is a space that is evolving. And because it's evolving and growing as a category, I mean, you guys wouldn't exist if it wasn't liquid and there weren't opportunities in the space. So on your side, could you maybe paint a picture for us of your investment activity? Like, how many investments have you made, in this particular space with this first fund?
Yeah. And, with your story there, while we don't invest in insect protein companies for a variety of reasons, you've definitely hit on one of the interesting aspects of this sector and investments in this sector relative to some others, which is that when it comes to food, the obvious things matter, right? Tasting good matters, price matters, convenience matters, but perception and culture and those sort of softer things can matter a lot as well. And so if you're investing in technologies or brands in the space, you've got to keep in mind that wide set of factors that influence consumption decisions. It can be a bit more idiosyncratic, perhaps, for lack of a better word, than some other sectors could be. So in terms of us and how we're approaching it, the sort of companies we're investing in, the number. So with our Fund 1, so we're still adding a few final companies to our Fund 1 portfolio. We've started raising our Fund 2 in the past few months, so we'll be investing out of that one shortly. But we have about to do probably our 30th investment in the Fund 1 portfolio, and we'll add maybe 2 or 3 more. So we'll top out somewhere between 30 and 35. And then our Fund 2, which we'll be deploying over the next 4 or 5 years, will be about the same, another 30 to 35. So it is a good number of companies, and it's fairly diversified. While it's all within this food and ag tech and future protein sector, it is spread both across a number of different geographies, but also a number of different company types. So to give examples of some of those subsectors within the space we're investing in, maybe I can start with 2 that are actually from your backyard, from Denver and then nearby Boulder, Colorado. I was just out last week for a meeting with one of these companies. So at the high level, we invest both in brand-driven companies, so packaged foods companies that have products on the shelf or in restaurants that you can go out and buy either in the US or elsewhere, as well as companies on the technology side where they're developing either ingredients or other inputs or services into this sector, or producing alternative proteins using high-tech, tech-driven methods. So, and we have an example of each of those broad bucket categories there in the Denver metro area. So on the first of those, on the consumer goods side, just as an example, we've got a company called NoCal based in Denver, which does plant-based protein bars and powders and similar, plant-based protein supplements. Excellent product and 20,000 plus points of sale, doing excellent from a revenue perspective, distributed nationally around the US and most leading supermarkets, convenience stores, et cetera. So I think that would be an example of a company on the brand side that's done really well. And their value proposition is, look, we've got a great tasting product with a really good macronutrient profile, high protein, low fat, low sugar, but we're plant-based. There's no whey protein or things like that. And we actually taste really good. Plus kind of, nice brand, nice packaging, et cetera. So we invest in companies in whether it's plant-based protein, plant-based dairy, plant-based meat products, plant-based meals and entrees, kind of across that packaged food side of things, both in the US and globally. And then on the other side of things, on that tech-driven side, there's a number of different verticals there. So the one we invested in based out of Boulder, just outside of Denver, is a super interesting company called Bond Pet Foods, which produces real meat protein, so chicken muscle protein and other meat proteins via precision fermentation without the need for live animals in the supply chain. So basically using a sort of a similar technology to what's used in beer brewing, a similar technology, really an identical technology that's used for some other food ingredients and in some non-food sectors as well, but repurposing that technology to produce real meat protein without live animals needed in the supply chain as an ingredient input into the pet food space. And they're working with a couple of the biggest global pet food brands right now. And we invest in a variety of companies on the tech side. So that would be an example, among others, of companies producing meat or dairy protein without live animals. In addition to those sort of companies, we've invested in some companies on the seed genetic side. So companies that have modified, say, plant protein crops to have new advantages that the typical crops don't have. We've invested in companies doing machinery used to produce products in any of these types of categories, some service providers into the space, and similar. So it's kind of a diversified set of tech and brand-driven companies, both in the US and outside the US.
Amazing. I've been showing, if you guys are catching this on the audio version, head on over to YouTube, some cool stuff research-wise. That's up on your website. There's a piece from Bloomberg, talking about the trend in the space. It's a category that's basically it's going to be 10x by 2050, evidently. And so I'm curious though, why? Why do you? Is it in your thesis? Like, what's the why? Is there more to your investment philosophy than just making a return for your LPs? Is there a motivation from you and your team around contribution to humanity or anything like that? Because it seems to me like there's something there.
Yeah. So on the individual investment decision level for the fund, our fund, Lever VC, we're a returns-driven fund. So when we're making investment decisions on a deal-by-deal basis, it is just with an eye towards returns. But that being said, this category we invest in, every company in this category is a company where, to the extent that they succeed financially and commercially, they're also going to have very significant positive benefits for sustainability, for animal welfare, in most cases for consumer health, and so on. And so in terms of why, for me personally, I work in this area and invest in this area, certainly it is. Certainly my interest was captured because of those positive benefits. And as the sector started growing more quickly and diversifying and so many new technologies began to be developed, that then created this situation where it's just such a nice overlap of financial opportunity plus companies that really do have these great benefits for the world. On the sustainability side, just as an example here, Boston Consulting Group put out a report last summer that looked at the top 15 or so areas, that some investment areas that sometimes get called impact investment or bucket under that label. And what it found is that of all these top categories, this alternative protein space was far and away the investment category that gave the greatest return per dollar of investment when it came to mitigating climate change and its effects. And at the same time was one of just a couple areas within impact investing where there is a very strong financial case in terms of what those returns and return multiples can be. So it really does sort of this nice intersection where, again, that financial success and commercial success of a company in the space is nearly linearly correlated with positive impacts, because the vast majority of consumption and purchasing decisions, et cetera, within this category displace conventional animal protein purchasing. And that has big benefits for reducing carbon emissions, for saving land, water, et cetera. Certainly removes a huge amount of intense animal suffering from protein supply chains. And in most cases, is very beneficial for consumer health as well. Mm-hmm. So yeah, certainly there's all those factors tying in. And those things, those public social benefits, environmental, et cetera, are, I'd say, one of the tailwinds driving the growth of the sector that's informing both individual consumer purchasing decisions as well as government interest in growing the sector. And you've seen grant funding from a variety of governments around the world and very supportive statements from a variety of governments around the world wanting their country to advance the sector. I mean, folks as far apart in certain ways as, say, Xi Jinping of China and Donald Trump and now Joe Biden from the US, all three of them, along with presidents and premiers in Israel, India, Netherlands, the UK, elsewhere, Australia, have all put government funding towards this space, at least to some degree, but B, probably even more importantly, voiced, we want our country to be among the leaders in this category. And so I think when you see governments and countries as diverse as some of those, all supportive of the space and wanting it to grow, you can get a sense that there's real public sector interest as well. So those sustainability, et cetera, motivations are one from both a consumer and a governmental perspective, but you also have other things. Individual consumer health is actually the largest motivating factor for individual buyers. So if you look at people buying these products, the most typical purchaser situation is somebody that consumes meat, consumes dairy, but they're adding more of these alternative proteins and plant-based proteins into their diet to improve their health, to moderate their animal protein intake because it's just simply good for them. And then in the long run, while this is not a major driving factor today, if we're taking kind of a 10, 20, 30-year view, as I mentioned earlier at the top of the show, historically, animal protein consumption in total globally has doubled about every 30 years for the past century. It's projected to do so again in the next 30 years. And obviously, there's some point where we start to outstrip the planet's carrying capacity for just having the land and water and energy resources to produce that much food and that much protein. And even far before we get to that total carrying capacity, price pressures just start to build, right? Land becomes scarcer and more expensive. Water and energy become scarcer and more expensive, oftentimes. And so we're going to see this squeeze where the cost of productions of conventional animal protein continues to go up. The resource challenges continue to go up. And that creates this additional kind of resource constraint that will push forward this space in the years to come. So if you look at projections from investment banks or research agencies, they nearly uniformly have very strong growth of this category through 2030, and even stronger as you get to another decade and two beyond that.
Amazing, man. It's very, very cool to hear what you're saying, to be honest. And with the limited knowledge that I have in that space, it certainly seems to me that it's a space that needs to evolve. It needs to transform. And I think if you're playing, and I think what you've done really well, just being a business person, is you've niched into a space. You could invest in anything if you're sitting with a $50 million fund, as an example, or maybe more. I don't know. But my point being is, like, you niched into a space which is protein transformation, and bringing a fund to that and driving the innovation and the transformation agenda of the private and the public sector, which is exciting. I do have a question though. When you raise a fund, like you said, this is your first fund, right? And then you're raising number two afterwards, right?
That's right. We're investing now out of the 80 million fund one, and we're, while still investing out of that, starting to raise our fund two.
Got it. Cool. So when you raise that first fund, what is an LP, when you go to them and say, hey, we want to raise a fund for protein transformation? I'm using that just as a label for today. But what factors go into an LP working with a fund such as yours? Do you know what I mean? Are they looking at it? Also, obviously, they're LPs. That's about return, of course. But are there other factors that go into their decision to work with Lever VC specifically? Because as an LP, I have all the VCs in America I could potentially work with. So why do they choose you guys? And what other factors are shaping an LP's decision to fund one to 80 million? Obviously, fund two, depending on what kind of returns you're getting, it's going to be bigger than that, hopefully. So what factors drive their decision making in your space?
Yeah. So, I guess two of the biggest areas that they would be looking at in making that decision would be, why is this category of interest? Why is this, use your term, protein transformation category of interest? And why is there opportunity there? And how should we think about that opportunity? And then secondly, within that category, why Lever VC specifically? So I think both of those are obviously key questions, and we're certainly in the mind of any LPs that have partnered with us in the past or present. So on the former, in terms of the sector opportunity, look, this is a huge category. Annual sales of animal protein are about 1.5 trillion USD. And as mentioned, the alternative protein category is a bit over 100 billion in terms of annual sales. So it's a already large category in a significantly larger still addressable market that's going to double in the next 30 years in terms of that total addressable market size. And it's one where there's just been far less innovation, historically, far less innovation and disruption than what we've seen in energy and transportation, and certainly software and a variety of other sectors. So it's really ripe for that sort of innovation and disruption. So when you couple that with the fact there's also been an increasing number of successful exits in this category in the past 4, 5, 6 years, some blockbuster, unicorn $1 billion plus IPOs, but also 15 plus 100 million USD plus acquisitions that have happened in the category in the past 6, 7 years. along with some smaller exits, of course. There's now this history of those successful exits, and investors, especially early stage investors, doing quite well if they invested wisely in the category. So I think it's that growth of the category, the financial opportunity, the size of the category. For some of them, there's also other motivations. So, for example, with our Fund One, the majority of the investors were kind of split between corporate VCs, primarily food corporate VCs, some conglomerates, and family offices, and then some funds of funds as well. And among those, for folks on the corporate side, there's other motivations as well. And that, aside from the potential financial opportunity with an investment, they view there as being business unit opportunities, right? So meat companies, dairy companies, packaged foods companies, ingredients companies, and similar that see what's going on, they see the space growing, and they view it as either a threat to some of their existing core businesses or an opportunity, or in most cases, both of those things. And so they may already be doing things in this category, but their reason for partnering with a lever would be to better understand that sector at a very granular level. Who's doing what are the trends, what are the opportunities, and how can we capitalize on those opportunities in the long run as a business. You also have a few folks motivated by viewing this as a space that has a positive impact, but that's definitely the minority of folks that partner with us. It's largely the direct financial returns, and then for some of them, that indirect financial benefits, business benefits. Some of them also looking to do direct investments in the space, and we try to be very collaborative and share a large volume of direct deal opportunities with our LPs. So I'd say in terms of interest in the sector generally, those would be the main reasons for our LPs. Why lever itself? Our partners, I believe our partners have together done more deals in the space than any other traditionally structured fund in the world. So we've been investing in the space for 9 years across, I think, 70 plus different companies and close to 100 deals at this point in the space. Strong track record of returns, both from a family office investment period, 2014 and 15 through 2018, and then with the Fund One, 2019 through current. So I think it's that real sector specialty and expertise that, success requires focus. And if you want to make smart investment bets in any area, you need to know that area quite well. And I think we do, and I think our LPs think we do as well. So that would be, I think, the reason for choosing Lever VC if you're going to invest in this food tech, ag tech, protein transformation area.
Mm-hmm. And on that bombshell, we're going to take a quick break. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before, and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. And we're back. Nick, so you mentioned 70 odd deals, 70, 90 deals, investments. You do a lot in this space. And it's an ongoing concern for a lot of founders looking to raise money, and that's and it's probably a big reason why I do this part of the show, this series, I should say, is that how do you decide on who to back and who do you not invest in? So could you walk us through? Is it like pre-revenue? I mean, by the way, it's also is it regulated? Is it always pre-revenue? Do you know what I mean? And it's not always pre-revenue, but walk us through like what factors are driving your mindset around, well, do you back this startup or not?
Yeah, and obviously different investors and funds will take different approaches here in terms of what ours is. So thinking about those two main buckets of companies that we invest in, the more technology-driven ones, and then the brands, product companies. So on the latter, when it comes to product companies, we wait till the products are in the market and there's enough sales that we can look at how those sales are going, how sales growth is going, how the quality of the products compares to competitors, to make hopefully good judgments about future growth. So at this point, we're waiting for companies to have at least around $1 million in annual sales run rate USD before we invest. So we can see, can they execute on selling? How many units are they selling per store per week? how does that compare to peers? How does their taste compare to peers? To get a sense of, okay, they know how to sell, buyers like the product, customers like the product, sales are increasing, points of sale are increasing. Who knows how far it will go, but we can be cautiously optimistic it will grow quite significantly from where it is now. So we look to those things. Certainly, we're looking at the quality of the team. Obviously, that's so critical. From a quality of the product perspective, we would only invest in a brand that we think is number one or number two in terms of just how good it tastes in its category in broad geographic region like North America or Latin America or so forth. Now, both by our own taste buds, and we often do small focus groups. And then valuation and deal terms are very important. This has been a fairly hot sector the past couple of years, and I think with any hot sector, there's pluses. There's capital coming in to support your portfolio companies, but there's also deals that get overhyped and overvalued. So we've always been very valuation disciplined, I would say, and just if we think we would be overpaying, we just don't do the deal. So being quite conscious about those sort of deal terms as well. On the technology-driven side, we do invest pre-revenue, and so in fact. I'd wager to say every single one of the technology-driven companies we've invested in, or perhaps all but one, where pre-revenue at the time we put first check in, if not second check as well. And so what we're looking for there is companies that are really pioneering some really interesting technology, and they're either the pioneers globally or at least in a very large region, like a continent or something like that. And the technology they're doing is achieving or should achieve, if it is done correctly, one of two things. Either number one, it's making products in this category taste and function significantly better and therefore be much more appealing to consumers. Or number two, it's lowering pricing for products in this category for consumers and therefore making it more appealing. And then again, certainly the same concerns around team, around pricing and so forth. Those would be the key things.
Nick, where does it go wrong for a startup? So let's just say a pre-revenue technology bucket startup doing some interesting stuff in the protein transformation category as an example. Or maybe I'm revenue generating, I'm doing 800K, let's just say. And I come to you and I present what my investment ask is, problem, TAM, all that good stuff you would expect a good founder to know about his business or her business. And you obviously, being an investor, get pitched a lot. So where does it go wrong? Like, what is a common mistake you see founders making when engaging with a VC firm such as yours?
So go wrong in terms of they're trying to have us invest and we don't. And so it's gone wrong for them from front.
Absolutely, yeah.
Yeah, so there's obviously all the performance things that matters, right? Whether it's a tech-driven company or a brand. And so if your sales numbers are not very good, your turnover is not very good, your product quality is not very good, no matter how smooth and polished you are in a pitch session or your pitch deck, then you're going to be in a tough situation, or at least you should be in a tough situation, right? If you're dealing with good investors. So obviously getting those fundamentals right is critical. But as that's probably pretty obvious in terms of going into those meetings and the presentations and pitch decks and so forth. So certainly we're looking for people that are very smart and have a granular knowledge of what the company is doing, right? So the specific data points should be at their fingertips. It should be in the forefront of their minds. And if we ask a question about margin or weekly turnover in a certain store versus another store or so forth, like they should know their business at an in the weeds level, so they can just answer those questions immediately if they're the founder or leader. So having that very granular understanding of the business and us being clear that they have that, I think that's an important thing. Having a sound strategy, a realistic, practical strategy. Some founders have very realistic strategies. Some have probably underly ambitious, too cautious strategies, and some have way unrealistic expectations, or at least they make very unrealistic projections about where they think they're going to be. And certainly different investors view this different ways. But if I see a pitch deck and the company is at a 200,000 run rate now, and they're telling me that 4 years from now they're going to be doing 50 million in sales, it's just to me it tells me either number one, they are completely unrealistic and completely unpractical and thinking about what's possible and making smart decisions accordingly, or B, they have no qualms about just completely lying to me and to other investors. So I think having those realistic expectations is pretty critical, and being very honest about those things, right? You want to be polished and you want to come across as smart, but if there's a heavy BS element there, it's a major turnover. or turn off. And then last thing I would say, and obviously there's a lot of things I could say, but maybe one last notable thing that comes to mind is presentation does matter a lot. So if you think about just the quality of the pitch deck, the quality of a verbal presentation, that says a lot. And you can make the case that those things shouldn't matter very much. And certainly there's sometimes companies that do well, even if the presentation style is not great, communication style is not great, graphic design is not great. But I think and so you could say to some extent those things, one could argue that to some extent those things shouldn't matter. I think the case for them mattering somewhat is they're a reflection of self-awareness. And so, in my view, a smart founder should realize that, okay, human beings are human beings. They have the psychological predispositions that they have, and to persuade people to have trust in you and do you what you would like. And in this case, give you some money and some trust and some support, that these sort of factors are going to weigh into their considerations. So let's do a very good job on these factors. So it's to me that doing that well reflects self-awareness that these things matter. And if someone in a company is smart enough to be self-aware in these manners and execute well based on that self-awareness, I draw from that probably they're going to do the same thing in conversations with category buyers and vendors and so on and so forth. So I'd say those will be some of the things that if they're not done right, can be turnoffs and make things go poorly for a company that's raising.
So basically, if you if you're doing a projection for for Lever VC guys, and you're making $100,000 in January, and you drag profits, and you drag that cell across, and you make 1.2, do not make a chart out of that.
Yeah, I mean, and obviously other investors have seen this, but I mean, we really have gotten decks where there's zero revenue, right? This year, or, sub 1 million, but the company is saying we're going to be making 50 to 100 million within 4 to 5 years in a, packaged food space. Doesn't happen, never happens. It's yeah. You get some pretty crazy projections there.
Yeah, you got to forgive them, right? I mean, come on, they're trying to sell you the dream, right? Because I suppose if you can logically connect the dots. You could understand. It doesn't look good when you're not in reality. But what is reality? VCs also get it wrong, and I would be empathetic I would correct them, but I would be empathetic and say, look, I get it. You want to make sure that you're selling me the dream here, but actually, given our expertise in the sector, which again is what I love about what you guys have done as a firm, here's actually the reality for you. Go away and fix it, come back, show us that you are amenable to negotiating your own ideas of what success looks like, and then if we can align at that point, then maybe we could do a deal.
Yeah, I think that's an understandable view, and clearly other investors have different views on that and how they take that sort of thing. Some take it with a grain of salt. That doesn't affect them either way, really.
Yeah. Well, it's funny. I've got this massive network of startups, and most of the. So I was chatting to this guy called Billy Brush, right? So he's got this ridiculous startup. It's insane. It's definitely a unicorn. It's backed by Scott. I forget his name. Scott Sandell. He's done like 12 IPOs. Amazing team. Everything. It's all there. But he's out in Cali. And I said to him, so what role when you talk to a VC there, and you tell them you have this crazy idea, like you want to colonize Mars, what happens? And he goes, well, they probably believe you because they're based out in Silicon Valley, But so, and it's all context, isn't it? So, I want to change gears quickly, Nick, and kind of get some more perspective from you. So you've done, let's just for argument's sake, say you've done 70 investments. You've had a number of exits also. And you've also, like any good VC firm, you're not going to win 100% of the time. So you've also made mistakes. So what would you say has been your greatest success and failure as an investment firm? And what would you put the difference down to? What made the difference?
So on the success side, I mean, thinking not in terms of a specific company, but more thematically, on the success side, I would say knowing the space we invest in at a granular enough level that we can make smarter decisions from that in a few different ways. A, knowing the full peer set. So if we see if we get a pitch deck from a company developing a certain technology, we know essentially every other company working on the same thing around the world and how things have been going for them and their approach and so forth. So knowing that full peer set, knowing some of the trends and dynamics of the sector, and those other aspects that would allow for judicious decision making. Again, just coming back to success requiring focus and deep knowledge. So I'd say that would be one. And the other tied for biggest item thing would be early stage deal access, right? So because we built up networks in the space over a good number of years, getting deals very early when equity is obviously much cheaper. So the combination of those things, getting them early plus the judiciousness to at least many times make a smart call there to invest or not invest. I'd say those things are probably where the vast majority of the value add is for our LPs and for generating returns. If I were picking something after that, I would say the ability to have real value add to the company in terms of bringing in additional capital and partners for follow-on rounds, and also just providing sound strategic advice, which also filters back to, I think, knowing the sector well and being able to make good advice based on that knowledge. Mm-hmm. So I would say, when things go right, those are the main reasons that things have gone right and we've had really great growth and valuation or some nice exits or so forth. When things go wrong, it's hard to say because indeed, there's companies that go a lot better than you would have expected and ones that don't go the way you would have expected, of course. I'd say for us, what are the ones when ones have not gone so well, what's the reason? On the brand-driven side, I would say one thing that we've shifted when we were starting to deploy our Fund 1 about 4 years ago, for the first year or so, year and change, we were comfortable investing pre-revenue or trivial revenue, you could call it, sub 100K, maybe even 100, 200K run rate. And not all of those have worked out. And so we've shifted to now waiting till there's more of that track record. So we just have that longer history of data points and proof points on execution ability to look to. So I would say that's one lesson we've learned over the past number of years and influences our decision-making now. The other thing I would say is that what we've seen, I'd say with maybe a few companies invested in when I was investing in a family office period a good number of years ago, and that we've also seen from non-portfolio companies, that's still a lesson learned, is the value of valuations growing too quickly and too much capital being brought in the door, right? Because of the hype. Like obviously there's pluses to that, right? But there's very significant downsides as well. And so I think learning that companies certainly need to pace themselves in that regard. And being cautious of that overhang that could come if the amount of capital taken in starts to exceed the real, honest, objective value of the company. So yeah, I'd say those are the biggest things that come to mind.
Okay, great, fantastic. Nick, let's just say for argument's sake, you were going to cut a check for $5 million to they've done everything right. They haven't messed it up. You're excited, and they've given you a sense that this is a good investment opportunity. You want to cut a check for today, say $5 million, whatever, pick a number. Do you have a preferred structure of capital to do the deal? Do you know what I mean? Like, is it kind of a safe note? Do you do a convertible? Like, what is your kind of go-to at the moment?
Yeah. So for us, a $5 million check would definitely be at the high end of what we do. And there'd be a bit of a difference in terms of what we would view as best based on this check size. I would say many of our investments, at least many of our first investments, are convertible notes. For the space that we invest in and the stages we're investing in, often starting at pre-seed or seed, most pre-seed, seed, and pre-A rounds in this space are either safe notes or convertible notes. It's definitely a minority that are priced equity rounds. By the time you get to Series A, then it's typically an equity round. So I would say numerically, the majority of investments we're doing are convertible or safe. I would say, if it's a smaller check earlier round, what would our preference be? Convertible note. I'd say it's quick, it's cheaper. We can build some protections into that. And relative to a safe, there typically is, and for us, there always is a lot more of those investor protections. So yeah, for a smaller earlier round, convertible note would be preferred.
Okay, Fantastic. So you mentioned you've had a few exits, and well, there's a lot of liquidity in the space also, but exits too. And very curious to understand from you, like, how do you evaluate and prioritize an exit? Obviously you have LPs to give a return to. You have a portfolio of whatever 20, 45 investments, 50, 70, whatever. And at some point someone comes along. You mentioned strategic acquisitions earlier too. And so someone just wants you to go away, or help me to solve this problem because, we can't, because we just can't do it. We're a fertilizer, like whatever, that happens every day. And you've got this cool, sexy startup and, a strategic acquirer comes along, goes, listen, I want you guys to go away. Or we just want to take what you've built from a technology perspective, integrate it into our mothership, and you guys go away, or what have you. So, that's just one context. There's obviously many, many potential outcomes there. But how do you decide that we want to do this exit?
Yeah, I mean, it's rarely up to us in that we're taking minority positions in the companies, the companies we invest in. Sometimes we have a board seat, but we don't have board control over the companies we're investing in. So those decisions are essentially not made by us. They're made by the company. The only exception to that would be if we chose to do a secondary sale, right? Take our equity in a company and just privately sell it to somebody else, our stake, which probably will happen with one or two of our investments, but that's going to be the exception. So it's largely up to the company. But in terms of how we think about it and how we would advise the company to think about it, I think it would, much like investment in any category, it's kind of this calculus and best guess on, okay, what is the price now? And what price could be gotten, 1, 2, 3, 4, 5 years from now, based on the trajectory of how things are going and how we expect them to play out, and then the time cost of money for that interim period. So I think that's how we'd be thinking about it. It certainly has been the case that we have both Lawrence and I are the founding partner. Companies we invested in during the family office period, 2014 through 2018, have exited. For our fund one, these are all still early stage companies, all Series B or earlier. So none of them are at the point where an exit would make sense, but some of them have been approached by companies that wanted to either acquire them or take them public through reverse listing. And we felt that it wasn't the right time for any of those companies, that they had experienced some nice growth and value, but they were on a very good trajectory. And to exit now would be leaving all that value that's to be built up in the next couple of years off the table. So encourage them to think about it that way, showed some data points around some of the relevant factors, and encourage them to politely decline for now, while staying in touch with those opportunities for the future. So I'd say that's generally what we're thinking about when we're thinking about that question.
But it's the exception to offload your ownership on the secondary market, right? You would basically listen. We're in for the long term.
For sure, yeah. I think when would we kind of try to pull the trigger on an exceptional case there? It would be, we think, basically those same factors I was mentioning earlier. What's the value now, or the valuation now that the secondary could be sold at? Where do we think the company will be, 2, 3, 4, 5 years in terms of valuation? And are those things close enough that the time cost of money just doesn't make sense to hold it for that longer period? So maybe it could double if things go well over the next 5 years. But if that's about it, and there's risk inherent, and we can sell it now, maybe that changes the calculus. So it's just based on that, those sort of course, best guesses. Yeah,
exactly. A whole other conversation you could just do on that one.
Indeed.
How the hell do you time value your money, man? How do you predict that stuff? Well, good luck. But I understand, and so thanks for that. So we're getting to the latter part of the show, Nick. So a couple of questions, and then we'll get into closing up. So you've been in the space for some time. What keeps you up at night about the world of venture capital today?
Specific to our sector, or more generally speaking?
Your call.
So I guess both, more generally speaking, but also that certainly factors into the sector we invest in. It repeatedly surprises me, perhaps it shouldn't, but it repeatedly surprises me the level of what I would view at poor decision making that happens. And I'm sure you have 10 people on the show and all of them would have the same thing, but from a different perspective of what's smart and what's not smart decision making. But I would say looking at the investments made in our sector, which I would generalize to presume is happening in other sectors we don't look at as well, there just seems like there's a lot of poor decision making, both on the to invest side and on the to not invest side, from a general perspective and also from a valuation perspective. There's just so many, my view would be there's so many innate human cognitive biases that are in too many cases steering the ship of investment decision making. And so that worries me that presents a couple problems that worry me, right? So one is it means that there's always question marks of even if a company that's very good on the fundamentals will get the additional capital needs in the future to continue growing. The greater concern is sort of the flip side of that, which is that companies that do not deserve to raise, in my view, don't deserve to raise much, if any, money, are in some cases raising massive amounts of money at massive valuations. And there are definitely going to be negative consequences of those things when those companies crash and burn, because it can dissuade, the way that people are. If an investor makes a really bad decision there, works out really bad for them, the human proclivity is to say, oh, we invested in the sector and it did badly. There's not opportunity in the sector, not I made a bad decision, right? And so my fear is that in this sector, those who don't know the space very well and who make poor decisions, when it becomes clear in a few years that those were poor decisions, they will be turned off from this category. They will say negative things about this category rather than assigning blame, where it really should be, which is them making uninformed decisions when they probably shouldn't have done so. So I think that's going to cause issues for the sector that we invest in a couple of years in the future, that uninformed decision making that drives a lot of capital. And this sort of goes along with it. But the other thing that keeps me up at night, metaphorically speaking, with our sector specifically, is the alternative protein space we invest in. Like we were chatting about earlier, 110 billion annual sales. Nearly every category in the space is growing year over year in terms of sales globally and here in the US. But if you look at headlines related to the sector over the past 3 months, 6 months, like those headlines are basically Beyond Meat stock prices doing bad and the company is not doing very well, which are true data points. But the broader set of data points about the sector as a whole and so many other companies in it and the long-term trends, those are left out because they're just not as newsworthy they're not as clickbaity as that sort of narrative. And so what we've certainly seen in the past few months is this incorrect understanding of the dynamics of the sector and what's going on based on basically one or two cherry-picked data points. And that combined with the very surface level thinking and understanding that seems to inform so many investment decisions in this category and other categories, those things also worry me because of the implications of those things for ease of access to capital and all the other things that portends. So grab bag of things there, but I think all of those kind of tying back to laws in our human nature and decision making and just the level of thought and the rigor of thought that people put into investment decisions, even when they're writing very big checks. And I think sometimes the lack of self-awareness about the extent to which you actually know a space or investment versus you don't.
Great point. This is why AI needs to come to the table and take this problem away for everyone.
I'm looking forward to it doing so.
Yes, dude. Like, come on, man. Let's get it done. You and me, Nick. Cool. So you mentioned the future. How do you see the venture capital space evolving in the next sort of 5 years or so, if at all?
I think 5 years is a pretty short time frame.
10 years.
I think if we were talking longer time frame, I would certainly hope that a lot more algorithmic quantitative decision making enters the sector in a similar way to which it entered to a meaningful extent the public markets. I would certainly hope that's the case. Obviously, it's harder because with private companies, it's much, much harder to get that information. It's essentially got to be voluntarily offered up by companies or investors or similar. But I would hope that it does move more strongly in that direction. I think it's to everyone's benefit. I think it's to entrepreneurs, decent and good entrepreneurs' benefits, certainly to investors' benefits and to societies. So I would hope it moves in that direction. I think it's got to move at least somewhat in that direction. as the world gets richer, there's just clearly there has been more and more capital going into VC and private equity generally. It's hard to see that changing in the next 10 years, barring some unexpected, globally catastrophic event. I would think the amount of capital going into private equity and VC does continue to go up. Those would be the only two things that come to mind. It's perhaps hard to be a better prognosticator than very general things like that.
Yeah, it's all good, man. Who knows? But sometimes I like to ask those questions just to see if someone's thinking about something or they know something I don't. Cool. So I'm going to have a quick bit of fun with you, Nick, and then we'll wrap up. But I'm going to give you the keys to the Matt Brown Show time machine. And I'd love for you to go back to yourself on day one, of investing. And if you think about all the things you've learned and failed at and things like that and succeeded at, what advice would you give yourself on day one about the world of venture capital or private placement investing?
I think the two things would be spend more time sooner with people who have a very good demonstrated track record of doing what you want to do. So learn very directly and just listen to people who actually know what they're doing and have done it well, how they think about it, their approach, et cetera. And the second thing would be read about and understand in more detail some of the broad data points about what goes into driving returns in VC. So from a portfolio construction, from a technical perspective, things as simple as that correlation between the number of deals done and that kind of bounds of best results to least good results, and how that narrows based on number of investments, and some of these other kind of high level technical quantitative analyses that have been done, and how that could or should inform decision making. I think those two things.
Very interesting. Very, very interesting. Nick, you're a smart cat and you're doing amazing things. Thank you so much for being on the Matt Brown Show. It's been a real privilege getting to know you.
Thank you for having me on, and likewise.
Anytime. Cheers, guys.